The 10-minute or 10 a.m. trading rule. If you've ever watched the market open, you know how chaotic the first few minutes can feel. Prices jump rapidly, volumes spike, and emotions run high. For new traders, this period can feel exciting and terrifying at the same time. For experienced traders, however, the opening minutes are not chaos, they're data. One of the most popular opening bell strategies is the 10-minute rule, often called the 10 a.m. rule. This simple yet powerful concept helps traders avoid early market noise and make smarter, more calculated decisions. It is widely used by day traders and intraday investors who trade stocks listed on exchanges like the New York Stock Exchange and the Nasdaq stock market. The stock market officially opens at 9:30 a.m. Eastern Time. But the market does not begin calmly. Instead, the opening bell releases a flood of overnight information into the trading environment. Earnings reports, global news, economic data, analyst upgrades, and geopolitical events all get priced in at once. Orders that were placed overnight begin executing immediately. Institutional traders, hedge funds, and retail traders all act simultaneously. This creates extreme volatility during the first few minutes. Prices often swing dramatically in both directions before settling into a clearer trend. This is exactly why the 10-minute rule exists. The 10-minute rule is a trading strategy that tells traders to wait for the first 10 minutes after the market opens before entering a trade. Instead of jumping into trades at 9:30 a.m., traders observe price action until 9:40 a.m. Those first 10 minutes create what traders call the opening range. This opening range becomes a critical decision-making tool. Just a quick reminder to please hit the like button and subscribe to the channel for more content like this. Also, you can visit us on the web at investmentees.com and use code BLOG to receive 20% off your next purchase. Traders watch the high and low price formed between 9:30 a.m. and 9:40 a.m. After this range is established, they look for a breakout above or below it. The breakout direction often signals the market's short-term trend for the day. It sounds simple, but behind this simplicity lies powerful market psychology. The first few minutes after the open are dominated by emotion and imbalance. Traders react to overnight news with urgency. Many buy or sell without waiting for confirmation. This creates false breakouts, sudden reversals, and unpredictable price spikes. Professional traders know that early moves can be traps. Waiting allows them to see where the real buyers and sellers step in. By 9:40 a.m., the market has absorbed much of the overnight news, early panic slows down, and price action becomes more reliable. This is why the 10-minute rule is often described as a discipline strategy rather than a technical indicator. Markets are driven by human behavior. Fear, greed, excitement, and panic all show up in price charts. When the bell rings, retail traders often feel pressure to act quickly. They fear missing out on a big move. This leads to impulsive trades. Institutional traders behave differently. They observe order flow, liquidity, and market reaction before committing large capital. By waiting 10 minutes, retail traders essentially align themselves with professional behavior instead of emotional reactions. This psychological shift alone can dramatically improve trading performance. After 9:40 a.m., traders draw two simple levels on their charts. The highest price reached between 9:30 and 9:40. The lowest price reached between 9:30 and 9:40. These two prices form the opening range high and opening range low. Once the range is defined, traders wait for price to break above or below it. A break above the high signals bullish momentum. A break below the low signals bearish momentum. The key is confirmation. Traders wait for price to clearly move outside the range instead of guessing the direction early. When price breaks the opening range, it often means institutions are stepping in. Large traders typically wait for liquidity and confirmation before placing large orders. When these big players enter, they create sustained momentum. This momentum is what day traders aim to capture. Instead of trading randomness, traders using the 10-minute rule trade confirmed direction. This increases the probability of successful trades. The strategy focuses on momentum trading. Traders aim to enter trades once direction is confirmed and ride the move for short-term profits. A typical trade might last anywhere from 15 minutes to a few hours. The goal is not to predict the entire day's movement but to capture the morning trend. Morning trends are often the strongest because trading volume is highest in the early session. Higher volume means stronger moves and better opportunities. One of the biggest advantages of this strategy is built-in risk control. The opening range provides natural stop-loss levels. If price breaks above the range and then falls back inside it, the breakout has failed. Traders can exit quickly and limit losses. This structure makes the strategy appealing for beginners and professionals alike. Clear entry. Clear exit. Clear risk. 10-minute rule in action example. Imagine a stock closes at $50 the previous day. Overnight, the company releases strong earnings. Excitement builds before the market opens. At 9:30 a.m., the stock opens at $52 and begins moving rapidly. Within the first 10 minutes, it fluctuates between $51.80 and $52.50. By 9:40 a.m., the opening range is set. Opening range high equals $52.50, opening range low equals $51.80 at 9:45 a.m. The stock breaks above $52.50 and continues rising with strong volume. This breakout signals bullish momentum. A trader enters at $52.60. Over the next hour, institutional buying pushes the stock to $54.20. The trader exits with a profit of $1.60 per share. This is a classic example of the 10-minute rule capturing morning momentum. Volume is the fuel of price movement. A breakout without volume can fail quickly. But a breakout with strong volume suggests real participation from large traders. When price breaks the opening range with rising volume, the probability of continuation increases. Many traders combine the 10-minute rule with volume indicators to strengthen their decision-making. The 10-minute rule becomes even more powerful when paired with simple technical tools. Traders often use moving averages, support and resistance levels, and trend lines to confirm direction. When multiple signals align with the opening range breakout, confidence increases. This combination creates a high-probability trading setup. This strategy is ideal for day traders, scalpers, and active investors who trade during market hours. It is especially useful for beginners because it simplifies decision-making. Instead of watching charts all day, traders focus on the most active part of the session. The strategy offers simplicity, structure, and repeatability. It removes emotional decision-making and replaces it with rules. Traders appreciate the clear framework and consistent opportunities. Over time, discipline and repetition can lead to steady growth. No strategy is perfect. Some breakouts fail, and losses are part of trading. However, the goal is not perfection. The goal is probability and consistency. When used correctly, the 10-minute rule helps traders stack the odds in their favor. Conclusion. The 10-minute rule or 10 a.m. trading rule is one of the simplest yet most effective strategies for navigating the stock market open. By waiting for the first 10 minutes of trading to pass, traders avoid emotional decisions and gain valuable insight into market direction. The opening range provides clear entry and exit levels, making risk easier to manage and opportunities easier to identify. While no strategy guarantees success, the discipline, structure, and momentum-focused approach of the 10-minute rule make it a powerful tool for traders looking to capture consistent morning profits. Thanks for watching.